The crypto market took a massive hit recently, wiping out $800 billion in market cap and liquidating $2 billion in leveraged positions. Bitcoin dropped 20% and altcoins got crushed even harder. But why is this happening? Is this just another routine crash, or are we entering a deeper bear market? Welcome to the Chain Point channel. In this video, we'll break down exactly what triggered this meltdown, from US trade tariffs to rising interest rates and why Bitcoin is reacting differently than in past cycles. We'll also analyze whether this is a rare buying opportunity or a warning sign of further downside. If you're wondering what's next for Bitcoin, altcoins, and the entire crypto market, you're in the right place. But before we continue our talk, don't forget to hit the subscribe button to stay tuned to what is happening in the crypto world. And remember, everything we say here is not investment advice. Always invest wisely. Let's get started. The cryptocurrency market took a massive hit recently, with Bitcoin and altcoins plunging as investors rushed to safety. The primary culprit? The US government's latest round of tariffs, which directly impacted 43% of US imports. This move sent shockwaves through global markets, creating a ripple effect that led to increased economic uncertainty. When traditional markets panic, riskier assets like cryptocurrencies tend to be the first to suffer, and that's exactly what we're seeing now. Historically, Bitcoin has thrived in times of economic instability, often seen as digital gold. But this time, things are different. Instead of acting as a hedge, Bitcoin dropped nearly 20%, touching a low of $91,000 lately. This suggests that, at least for now, investors are prioritizing cash over crypto, looking for stability rather than speculation. The sudden rush to the US dollar underscores a shift in sentiment, where even long-term Bitcoin believers are feeling the pressure. One of the biggest concerns is how these tariffs will impact inflation and interest rates. With expectations of a 0.7% increase in core inflation and a potential 1.2% drop in US GDP, the Federal Reserve is in a tough spot. If rates remain high, between 4.25% and 4.5% as expected, borrowing becomes more expensive, making speculative investments like crypto less attractive. Investors are factoring in the possibility of prolonged economic pain, which could mean more downside for Bitcoin. Adding to the chaos, a staggering $2 billion in liquidations wiped out over-leveraged traders in the span of hours. This level of liquidation hasn't been seen since the collapses of FTX and Terra Luna, reinforcing just how severe this sell-off has been. The overall market lost $800 billion in capitalization, a staggering figure that once again highlights crypto's vulnerability to external economic pressures. Panic selling took hold, exacerbating the situation and leading to an even sharper decline. But here's the real question: are we witnessing a temporary panic or the start of a prolonged bear market? While the immediate reaction has been brutal, Bitcoin's ability to recover in past crashes shouldn't be overlooked. Could this actually be a buying opportunity disguised as a crisis? Bitcoin's latest drop may seem extreme, but compared to past cycles, it's actually showing remarkable resilience. In previous crashes, Bitcoin has seen single-day losses of 50% or more. Think back to March 2020 or the Terra Luna collapse. This time, despite the panic, Bitcoin's drop was limited to around 20%, showing that volatility is decreasing as the market matures. This suggests that institutional players are stepping in to stabilize price swings, preventing the wild roller coaster rides of the past. One key difference in this cycle is Bitcoin's growing adoption among large financial institutions. With ETFs now holding a significant portion of Bitcoin's supply, there's a stronger floor of demand, preventing extreme crashes. While retail investors often panic sell, institutions tend to take a long-term approach, which has softened the usual dramatic price swings. This means that while Bitcoin is still volatile, it's gradually behaving more like a traditional asset. Despite this, the crash still wiped out billions in liquidations, proving that leverage remains a major risk factor. The rapid price drop triggered cascading margin calls, forcing traders to exit their positions. However, the speed of the recovery also hints that there's strong underlying demand. Each dip is being met with buyers eager to accumulate at lower prices. This pattern aligns with previous cycles, where Bitcoin experiences steep corrections before rebounding even stronger. If history tells us anything, it's that Bitcoin thrives on these boom and bust cycles. The 2017 bull run saw a massive crash in early 2018, only for Bitcoin to return even stronger in 2021. Now we're seeing similar patterns. Fear grips the market, but long-term holders remain unfazed. In fact, over 90% of Bitcoin holders are still in profit, proving that despite short-term panic, the broader trend remains upward. So, is this just another routine shakeout before the next leg up? If the past is any indicator, Bitcoin tends to rise from its own ashes stronger than before. Could this drop actually be setting the stage for the next explosive bull run? Many in the crypto space had high hopes for a US strategic cryptocurrency reserve, especially with growing political interest in Bitcoin. However, those expectations were shattered as Trump's latest policies showed no signs of embracing Bitcoin as part of the country's economic strategy. Instead of regulatory clarity or institutional adoption, investors got new trade tariffs on Mexico, Canada, and China, fueling economic uncertainty and shaking market confidence. The tariffs, 10% on Chinese goods and 25% on imports from Mexico and Canada, sent shockwaves across global markets. With nearly half of US imports affected, supply chain disruptions became a major concern. These policies stoked fears of a slowing economy, causing investors to flock to safer assets like the US dollar and treasuries, while abandoning volatile assets like Bitcoin. The market reacted swiftly, with Bitcoin plunging as traders recalibrated their expectations. Another major issue was inflation. With tariffs expected to raise core inflation by 0.7%, concerns grew over how this would impact Federal Reserve policy. Higher inflation could delay interest rate cuts, keeping borrowing costs elevated and reducing appetite for speculative investments. Crypto thrives in environments where easy money fuels risk-taking, but with rates still between 4.25% and 4.5%, the current landscape remains unfavorable for high-risk assets. Adding insult to injury, hopes for a Bitcoin-friendly stance from Trump's camp were met with silence. The idea of the US government strategically accumulating Bitcoin as a reserve asset, similar to how nations stockpile gold, was seen as a potential game changer. However, with no signs of such a move materializing, the market was left disappointed, leading to further sell-offs as investors adjusted their outlooks. So, with economic policies leaning toward protectionism and financial tightening, where does Bitcoin stand? Will it continue to be treated as a speculative asset, or could we still see a shift toward mainstream adoption? For months, the crypto market has been riding on a wave of optimism, fueled by the belief that Bitcoin would soon see large-scale adoption by governments. Some analysts even speculated that central banks could start holding Bitcoin as a strategic reserve. But reality hit hard. Governments have shown little interest in integrating Bitcoin into their financial systems, and instead of embracing crypto, regulators continue to tighten their grip. The recent crash reflects a harsh but necessary correction in expectations. Investors tend to overestimate short-term adoption while underestimating long-term potential. In the last bull run, narratives like institutional FOMO and nation-state Bitcoin reserves dominated discussion. While Bitcoin has indeed made progress, it's nowhere near the level of adoption that some had hoped for. The recent decline forced traders to reassess their assumptions, leading to a market-wide recalibration of expectations. At the core of this correction is a shift in risk appetite. As global uncertainty rises, with trade tariffs, inflation concerns, and stagnant interest rates, Bitcoin is being treated more like a high-risk asset rather than a revolutionary financial system. This shift is evident in how investors reacted. Instead of buying the dip, many moved their funds to safer assets, fearing further declines. This is a stark contrast to the 2020 and 2021 cycle, where every dip was aggressively bought up. Despite the sell-off, long-term Bitcoin believers see this as part of the natural cycle. Every bull run is followed by a cooling-off period where unrealistic expectations fade, making room for sustainable growth. Bitcoin remains fundamentally strong, but speculative excess had to be purged from the market before the next leg up. These corrections are painful in the short term, but they set the stage for a healthier and more stable market in the long run. So, does this mean Bitcoin's long-term potential is in jeopardy, or is this just another reset before the next explosive move? The crypto market doesn't exist in a vacuum. It moves in sync with global financial trends. Recently, China's aggressive push into artificial intelligence with the release of DeepSeek has sparked a tech industry shakeup, influencing investor sentiment worldwide. AI stocks have attracted massive capital inflows, pulling liquidity away from riskier assets like Bitcoin. As investors chase the next big thing, crypto temporarily takes a back seat, leading to sell-offs and market corrections. Adding to the pressure, China's DeepSeek boom is creating geopolitical concerns. The US government has already imposed restrictions on AI chip exports to China, fearing technological dominance by its biggest economic rival. These tensions have rattled global markets, increasing uncertainty and driving investors towards safer assets. Whenever uncertainty rises, Bitcoin and altcoins, still considered speculative, tend to suffer first. This time was no different as traders adjusted their portfolios accordingly. The correlation between crypto and tech stocks is also playing a role. Historically, Bitcoin has moved in tandem with high-growth tech companies, and as AI stocks surge, traditional tech giants face increased competition. With major investors rotating funds between sectors, Bitcoin finds itself in a challenging spot. The short-term narrative has shifted from Bitcoin as the future of finance to AI as the future of everything, leading to a temporary loss of momentum in the crypto space. Despite the recent downturn, Bitcoin's fundamentals remain intact. While AI may be the hottest trend right now, the long-term value proposition of decentralized finance and digital scarcity hasn't changed. Every market cycle brings a new distraction. Whether it's cannabis stocks, NFTs, or AI, eventually capital rotates back and Bitcoin regains its strength. Smart investors recognize this and use these moments to accumulate rather than panic sell. Trade wars have consequences, and this time, the crypto market is feeling the heat. The US government's latest tariffs are expected to hit 43% of all imports, directly impacting supply chains and consumer prices. Economists predict a 1.2% drop in US GDP and a 0.7% increase in core inflation as a result. When inflation rises, the Federal Reserve tends to keep interest rates high. Bad news for speculative assets like Bitcoin, which thrives in low-rate environments. Investors are now bracing for prolonged economic uncertainty. Higher tariffs mean higher costs for businesses, which could lead to slower economic growth. The fear is that a weakened economy will push people away from risk assets, forcing them to prioritize financial security. This explains why Bitcoin, often seen as a high-risk asset, took a major hit, while traditional safe havens like the US dollar gained strength. If interest rates remain elevated, borrowing becomes more expensive, reducing the flow of capital into crypto. For now, macroeconomic forces are working against Bitcoin, at least until the Fed signals a shift in policy. Despite the current sell-off, some investors see this as an opportunity. They argue that Bitcoin's long-term thesis remains unchanged: scarcity, decentralization, and resistance to government intervention. While short-term traders panic, long-term holders remain confident, knowing that past crashes have always paved the way for new all-time highs. The key is patience and understanding that crypto moves in cycles. Interest rates are the invisible hand that controls market sentiment, and right now they're not working in Bitcoin's favor. For investors, this means borrowing money remains expensive, reducing the appeal of speculative assets like cryptocurrencies. When rates are high, cash and bonds become more attractive, pulling liquidity away from riskier markets. Institutional money is also adapting to the rate environment. Instead of pouring into Bitcoin, large funds are hedging with traditional assets like treasury bonds and the dollar. The logic is simple. When risk-free bonds yield a solid return, there's less motivation to chase volatile assets. This shift explains why Bitcoin is struggling to break new highs, even with growing adoption and increased institutional interest. However, there's a twist. If economic conditions deteriorate, the Fed may eventually be forced to cut rates. A weakening GDP, rising unemployment, or a major financial crisis could trigger a policy shift, making Bitcoin an attractive hedge once again. Smart money is already positioning for this possibility, knowing that every tightening cycle eventually reverses. When that happens, Bitcoin historically benefits, surging as liquidity returns to the market. The numbers are staggering: $2 billion in direct liquidations and a total crypto market cap loss of $800 billion. That's more than the fallout from the FTX collapse, more than Terra Luna's implosion, and yet it happened in a matter of days. The sheer scale of this wipeout has left traders reeling, exposing just how leveraged and fragile the market still is. When prices crash this quickly, it's not just panic selling, it's forced liquidation on a massive scale. Leverage has always been a double-edged sword in crypto. In bull markets, traders use borrowed money to amplify their gains, but when the tide turns, those same positions get liquidated in a brutal cascade. The $2 billion in liquidations wasn't just retail traders, it included institutional positions, hedge funds, and even some of the biggest players in the space. This event served as a harsh reminder that despite growing maturity, crypto remains one of the most volatile asset classes in the world. What's different this time is the magnitude. Previous crashes, like the Terra Luna collapse, were driven by internal failures within the crypto industry. This time, external factors like US trade tariffs, inflation fears, and high interest rates triggered the meltdown. This suggests that crypto is becoming increasingly linked to the broader financial system. As institutional money flows in, Bitcoin is behaving more like a macroeconomic asset rather than a niche investment. Despite the chaos, long-term investors remain unfazed. Historically, massive liquidations have marked market bottoms, creating opportunities for those willing to buy when others are fearful. The biggest players in the game, whales and institutions, are often the ones scooping up Bitcoin at discounted prices while retail investors panic sell. Could this be another setup for a massive rebound? With all the panic and fear gripping the market, you'd think Bitcoin holders would be deep in losses. But here's the surprising truth. 90% of Bitcoin wallets are still in profit. That's a major contrast to previous crashes, where the majority of holders were underwater. This resilience suggests that, despite the recent sell-off, Bitcoin's broader trend remains intact. Could this mean the market is stronger than it looks? When comparing today's cycle to 2017 and 2021, the similarities are striking. In both cases, Bitcoin reached new all-time highs, followed by sharp corrections that shook out weak hands. Each time, the market rebounded stronger, with Bitcoin eventually surpassing previous peaks. If history repeats itself, this downturn could just be a temporary reset before the next leg up. The key takeaway? Bitcoin has survived worse and come back stronger every time. One reason for Bitcoin's continued strength is its shifting ownership structure. In past cycles, retail investors dominated the market, leading to extreme volatility. But today, institutional players, ETFs, and long-term holders make up a larger share of Bitcoin's supply. These investors aren't panic selling. They see Bitcoin as a long-term asset. This could explain why, despite the crash, Bitcoin hasn't fallen as hard as it has in previous bear markets. While short-term traders may be fearful, those who understand Bitcoin's long-term fundamentals are positioning themselves for what could be another explosive rally. Altcoins have always been the Wild West of crypto. Some explode in value while others fade into oblivion. But with over 10 million altcoins now in existence, the landscape is more saturated than ever. Platforms like PumpFun are minting over 500,000 new tokens per day, flooding the market with speculative assets. With so much dilution, many investors are questioning whether altcoins can still deliver the same explosive returns as in previous cycles. One major concern is the quality of these new projects. Unlike Bitcoin, which has proven its resilience over time, most altcoins are driven by hype, speculation, and short-term narratives. The sheer volume of new tokens makes it harder for any single project to stand out, leading to capital being spread thin. In previous cycles, a handful of altcoins dominated the market, but now, with so many competing for attention, it's becoming harder for any one token to achieve sustained growth. At the same time, Bitcoin's dominance is rising. Historically, Bitcoin tends to regain market share after major crashes, as investors rotate out of speculative assets and into the safer option. Right now, we're seeing that shift happen. Bitcoin remains relatively strong, while many altcoins are struggling. If this trend continues, the next cycle may look very different from previous ones, with Bitcoin capturing an even larger share of the market. However, this doesn't mean altcoins are dead. Innovation is still happening and new narratives will emerge. The key is distinguishing between projects with real utility and those built purely for speculation. Investors who take the time to research and focus on strong fundamentals may still find hidden gems, but the era of buy any altcoin and get rich is fading, replaced by a more selective and competitive market. Buying in times of fear requires a strong mindset. When sentiment is at its lowest, most retail investors panic sell while experienced players quietly accumulate. This is the same pattern we've seen in every cycle. Those who buy when others are scared often end up with the biggest gains. The key is to have a long-term perspective and not get shaken out by short-term volatility. But altcoins, however, require a more cautious approach. With over 10 million tokens in existence and hundreds of thousands being created daily, the space is more saturated than ever. While some altcoins will perform well, the vast majority will struggle to gain traction. The best strategy? Focus on Bitcoin as the core holding and only allocate a small portion of your portfolio to altcoins with strong fundamentals. The days of blindly betting on any token and making money are over. This is not financial advice. Always do your own research before making any investment decisions. Another factor to consider is the macroeconomic landscape. Interest rates remain high, inflation is still a concern, and geopolitical tensions are rising. These factors could suppress risk appetite in the short term, but for those willing to weather the storm, the long-term outlook for Bitcoin remains bullish. Every major dip in Bitcoin's history has been followed by new highs. It's just a matter of patience. So, after all this chaos, where does Bitcoin stand? We've seen massive liquidations, rising interest rates, and US trade tariffs shaking the entire financial market. But history tells us one thing. Bitcoin has survived every crash before and always comes back stronger. The question is, will this time be any different? If you've made it this far, you now understand the key factors driving this crypto meltdown. Will Bitcoin bounce back like in 2017 and 2021? Or are we in for a prolonged bear market? Let me know your thoughts in the comments. Are you buying the dip, holding, or waiting for lower prices? If you found this video valuable, smash that like button, subscribe, and turn on notifications so you don't miss the next big update. Thank you for watching this, and I'll see you in the next video.